The deal was never announced on television. There was no press conference, no applause, no flags behind polished podiums. Yet within months, billions of dollars began moving, quietly, across borders, through shell companies, offshore accounts, and boardrooms thousands of miles away from the land that made it all possible. How does a single mining agreement, signed behind closed doors, reshape the economic future of an entire continent without most people ever realizing it happened? On paper, the numbers looked familiar: foreign investment, infrastructure promises, long-term development. But beneath those figures was something harder to see. A subtle shift in who controlled Africa's resources. A recalibration of power between governments, corporations, and global markets. And a financial architecture designed not for headlines, but for permanence. For ordinary citizens living near the mines, life seemed unchanged at first. The dust still rose from unpaved roads. Jobs were promised, then delayed. For investors watching from London, Beijing, and Toronto, the signals were different. Commodity forecasts adjusted. Risk models flickered. Analysts leaned closer to their screens, sensing that something unusually large had just been set in motion. Journalists began asking careful questions. Economists spoke in guarded language. Governments, both local and foreign, issued statements that revealed little and concealed much more. This story isn't just about minerals pulled from the ground. It's about how modern wealth is negotiated, how influence is priced, and how the future of entire economies can be signed away in rooms the public will never see. If stories like this fascinate you, subscribe and join us as we uncover the hidden mechanics of global finance. And tell us, what country are you watching from? Long before the agreement existed on paper, the signals were already there, buried in export data, exploration licenses, and unusually quiet meetings between government officials and foreign executives. Geological surveys had confirmed what locals had known for decades. Beneath vast stretches of African land sat minerals the world suddenly couldn't get enough of. Copper for electrification. Cobalt for batteries. Rare earths for technology still being invented. Global demand was accelerating, but supply chains were tightening, and the pressure was beginning to show in commodity markets. At first the shift looked benign. Investment delegations arrived with polished presentations and promises of partnership. Governments, facing debt burdens and infrastructure gaps, listened carefully. For finance ministers, the math was seductive. Trade long-term extraction rights for immediate capital inflows. Roads, ports, power plants, funded not by taxpayers but by future resources. On balance sheets, it appeared responsible. In rural communities near proposed sites, the language was simpler. Jobs. Development. Opportunity. Yet contracts were negotiated far from those villages, in capital cities and foreign boardrooms where urgency was measured in quarterly forecasts. What few noticed was how quickly leverage was changing hands. Clauses quietly extended timelines from decades to generations. Arbitration rights shifted overseas. Revenue-sharing formulas favored stability for investors, not volatility for host nations. Analysts reviewing early drafts sensed something unusual: returns that seemed too secure in a sector known for risk. One economist described it privately as asymmetric certainty. The deal promised predictability but not for the country signing it. And as the final language was prepared, one last provision was added, small, technical, and easy to miss, that would soon redefine who truly controlled the wealth underground. That final provision barely registered outside a narrow circle of lawyers and analysts. It tied future production volumes to repayment schedules, effectively converting natural resources into collateral. On spreadsheets it looked efficient. In reality, it meant that if commodity prices dipped, more resources, not less, would be extracted to meet obligations. The risk, quietly, had been transferred downward. Not to investors or lenders but to the land itself. And once signed, reversing it would be legally and financially punishing. Inside government ministries, reactions were mixed. Some officials saw the agreement as a necessary compromise in a competitive global market where capital had options and countries did not. Others hesitated, sensing the long shadow it cast. But political calendars moved faster than geological ones. Elections loomed. Budgets needed filling. The deal was approved. Announced briefly. Then absorbed into the background noise of global finance, where transactions of this size happen every day. Outside official circles, the first real responses were subtle. Credit rating agencies adjusted outlooks. Not upgrades, not downgrades, but cautious notes about future fiscal exposure. Commodity traders began factoring in increased long-term supply from a region that had once been considered unpredictable. For ordinary citizens, the change was invisible. Life continued as before. But beneath their feet, the economics of their country had shifted. Wealth had been priced, timed, and partially pre-sold. And far away in foreign capitals, investors were already asking a more dangerous question. Not whether the deal would hold, but how much more could be extracted under the same model. The moment global markets truly noticed the agreement wasn't marked by an announcement, but by movement. Commodity forecasts began to shift almost in unison. Copper futures softened. Long-term cobalt projections widened. Traders in London and Singapore started recalibrating assumptions about scarcity, quietly adjusting positions based on supply that technically hadn't entered the market yet. The deal had transformed potential into probability, and probability into price. For those watching closely, it was the first sign that something structural had changed. Investment banks circulated internal memos framing the agreement as a breakthrough in resource-backed stability. Pension funds, hungry for predictable long-term returns, showed interest. Infrastructure investors saw guaranteed offtake agreements as insulation against volatility. On trading floors, the tone was cautious but intrigued. This wasn't a speculative boom. It was something slower, more controlled. Analysts compared notes, surprised by how little political risk seemed priced in. One strategist described it as remarkably calm for something this large, a comment that lingered uneasily in the air. Governments abroad reacted with a different kind of urgency. In capitals dependent on mineral imports, officials quietly welcomed the increased certainty. Supply security mattered more than sovereignty debates happening elsewhere. Trade ministries began referencing the agreement in policy briefings. Meanwhile, local governments faced growing pressure to accelerate permitting and land access. Time, once measured in years, compressed into quarters. And as the machinery of global finance synchronized around this single agreement, a harder realization began to form. If this model worked once, it wouldn't stop here. The pressure intensified when the first operational milestones were met ahead of schedule. Construction updates filtered into earnings calls. Satellite images showed expanded access roads and newly cleared sites. What had once been theoretical supply was now visibly taking shape. Equity markets responded with restraint, but debt markets leaned in. Bond spreads tightened. Lenders grew more confident. The agreement was no longer a promise, it was performing. And performance in finance has a way of silencing doubt. Inside the country, the atmosphere shifted. Local journalists began asking why production targets seemed disconnected from domestic needs. Labor unions noticed that subcontractors were increasingly foreign. Community leaders spoke of land disputes resolved quickly, sometimes too quickly. Government spokespersons emphasized long-term benefits, pointing to infrastructure projects still under construction. But economists watching public accounts noticed something troubling. Export volumes were rising, yet fiscal flexibility was shrinking. Revenue was flowing, but much of it was already spoken for. The future, it seemed, had been carefully mortgaged. Abroad, the reaction peaked. Competing nations explored similar arrangements. Corporations revised playbooks. Analysts warned, quietly, that a precedent was being set, one that favored speed and certainty over sovereignty and adaptability. On trading desks, the question wasn't whether the agreement was fair. It was whether it was replicable. Because if resource-backed deals became the norm, the balance of power between capital-rich investors and resource-rich nations would tilt decisively and permanently. As prices stabilized and markets absorbed the new reality, one truth became impossible to ignore. This wasn't just a deal. It was a blueprint. And blueprints, once proven, are rarely used only once. Years later, the consequences became clearer, not through collapse but through constraint. The country's economy hadn't failed. Growth figures looked respectable. Exports were strong. Yet policymakers found themselves navigating with fewer options than expected. When global prices dipped, there was little room to slow extraction. When domestic priorities shifted, contracts limited flexibility. Stability had been purchased, but at the cost of choice. Economists reviewing the outcome struggled to label it a success or a failure. It was something quieter and more revealing. For ordinary citizens, the impact was uneven. Some regions benefited from new roads and steady employment. Others watched wealth move past them, measured in tonnage and shipping manifests rather than living standards. The mines operated efficiently. The numbers balanced. But the sense of ownership felt distant. Journalists visiting affected areas described a strange duality. Prosperity visible in infrastructure, absence felt in autonomy. The agreement had delivered exactly what it promised, just not what many had assumed it meant. In foreign markets, the deal was cited as a case study. Not in ethics panels or political debates, but in investment frameworks and development finance conferences. It demonstrated how risk could be engineered away, how uncertainty could be priced out of entire economies. And that, perhaps, was its most lasting contribution. It showed the world that wealth doesn't always disappear through corruption or collapse. Sometimes it's simply structured elsewhere, legally, efficiently, and permanently. With time, the agreement faded from public conversation, even as its effects deepened. New administrations inherited it without authorship, bound by clauses written years earlier in a different economic moment. Attempts to renegotiate were met with legal complexity and financial penalties that made change feel reckless. Stability, once celebrated, became inertia. The machinery kept moving because stopping it had been made too expensive to imagine. And so, the country adapted, not by reclaiming control, but by learning to operate within limits set long ago. For analysts, the story carried an uncomfortable lesson. Global finance doesn't always extract through force or secrecy. Sometimes it persuades. It offers solutions aligned perfectly with short-term needs, while quietly redefining the long-term. Investors reviewing the deal spoke of it with admiration. Governments referenced it with caution. Citizens rarely referenced it at all because its influence wasn't loud. It lived in spreadsheets, repayment schedules, and contracts that outlasted public attention. In the end, this wasn't a story about betrayal or rescue. It was about design. About how economic futures are shaped not only by resources, but by the frameworks that govern them. The mining agreement didn't steal wealth. It reorganized it. And in doing so, it revealed a truth that echoes far beyond one country or one continent. In modern finance, the most powerful decisions are often the quietest ones, made far from the ground they transform and felt long after the signatures have dried. In the end, stories like this remind us that the global economy rarely announces its turning points. They arrive quietly, wrapped in legal language and long-term projections, shaping lives from a distance. Wealth doesn't always vanish in crises or scandals. Sometimes, it's redirected, slowly, methodically, through decisions that feel rational in the moment and irreversible later. And as the world races toward new technologies and new resources, the most important question may no longer be who owns the land, but who controls the future written beneath it.